Hi guys, this is MJ Lax and this will be the monthly update for the month of November. I'll talk about our main themes in the portfolio, so China, small caps and the UK. We'll talk a little bit about the performance. I will cover the closing in red that I just did for Athenex a few days ago, which I think is important to explain to you in a video format. And we'll generally cover a few companies, including Aston Martin, Ascensus, Athenex, Cine, and a few others. So let's jump in. So I'm really happy to be talking to you in the video format. It's been over a month, so I just thought there's just so many things to say. So I will put it in the video format, and feel free to leave a comment below here on YouTube or on eToro and ask any further questions. So last November, just to put things into perspective, we have 26.25% up. This November, we are over 10% down, so it's like a 36, almost 37% difference between these 2 months. So actually last November was the best month for me on eToro, and this November has been the worst. So this naturally relates to all the three strategies not really working out well. Obviously, we have the Omicron virus that has sent the whole market really down. So a little bit about, we had big short X20 on Germany 40, which exited us in profit via stop loss, unfortunately. Otherwise, we would have made over 100% in one day. As Black Friday, actually, the German index went 5.7%, so that would be like 110%, 114%. Unfortunately, I put a very tight stop loss, and this exceeded us, so we didn't participate in the kind of hedging game, and the market's going down. We didn't really profit on that one, whereas usually I'm quite well prepared for that. So that's a little bit unfortunate. So this month has really, everything has been going down. Small caps have been decimated again. I have reviewed the portfolio multiple times in order to see if I should change the strategy. Obviously, the 27% drawdown this year. We started the year with like 30% plus. Now we're in minus. So there's a 27% actual drawdown for the year. As you can see in the statistics, this is really, really painful. I know there are people like Kathy Woods who lost over 30% in her arc, and people are leaving. That's normal. In terms of MJ Lux copy, people are leaving as well. They are also venting their frustration on the feed a little bit more now than they used to. So obviously last year we finished with plus 40%. This year we're just below zero. I mean, the December started very well, so probably put us back in plus, but naturally going over 30% in February. Since then, it's been very, very tough, and the second half of the year has been quite dramatically bad. So let me talk about the closing the position in red. So Athenex. So Athenex received very good news from the UK regarding the marketing of their drug. So this is good news. So I looked at Athenex one more time, look at the revenue projections for the next 2 years. So actually we'll go slightly down in terms of revenue next year, but in 2 years we'll come back to the revenue we had before. But we were trading about $14, $15. Now we're trading below $2. So actually, I believe in Athenex in terms of their pipeline, because they have the numerous drugs that are already commercialized. So this is not a small biotech company that has nothing bringing the money. It's actually quite a lot, bringing quite a lot of money, over 100 million revenue a year. The valuation of the company is below 200 million a year. And I believe it can be a 10x if they're working in the oncology space, which I also feel very strongly about. I think cancer should be eradicated. I think Athenex is there to play a role in that eradication. So I'm very positive about on the company. Don't want to increase too much risk, but I actually like the news from the UK. So let me now explain very simply. There are four, I've mentioned that multiple times, there are 4 reasons for me to close a position in red. In this case, we had 50% loss on Athenex, and then I closed it and reopened. So there's 4 reasons. Number 1 is risk management. So what you need to understand is that risk on eToro is measured on the invested amount, not the value amount, okay? So let's say we had $10,000 in Atenex. If I invested 10,000 and it went 50% down, now we have 5,000, but the risk is generated on this 10,000 initially invested. So it brings a lot of risk, even though, I mean, especially so they went down because the standard deviation has changed for that stock. So even though we actually have 500 invested, we are pay kind of risk-wise, we are on 1,000. So I actually wanted to invest, at the next to 7,500, so kind of 3/4, so in between the loss. So I didn't want to come back to the same 10,000 exposure, but I wanted to increase it from 5,000. So I built a 7,500 position by selling Atenex in the 50% loss, and then buying it back to the level of 7,050. So now, even though the position is 50% more, because from 5,000 building to 7,500 is 50% increase, it's actually only 3/4 of the risk, because we have at the 7,500, not 10,000. So actually, in terms of risk management, this move reduced the risk that Atenex brings to the portfolio. And since the stock went from 14 to about 2, below 2, then that's obviously a huge standard deviation. So it's a company that generates a lot of risk. So please understand that every move that I make, there is a reason. In this case, there are 4 reasons for that. So I'm not just doing that to massage the stats. In fact, to address that, I think investors prefer, or copiers prefer, to see minus 50%, because they know they're getting a great deal on the stock, rather than 0 or plus 10%, because then they will say, okay, maybe the train has left the station. So it has nothing to do with the numbers. I couldn't care about it less. And so, as I said, minus 50% can actually be positive, so it has nothing to do with that. So the number one, I reduced the risk for Atenex, even though I increased the position. So I think this is quite a sensitive, a kind of considerable, smart decision that on my part, where I can reduce the risk and increase the position. So that's number one. Number two, obviously, is tax harvesting. So many of you think this is the only reason. It's not the only reason, but it's one of the reasons. So taking this 50% hit and reopening on the same level is actually accounting for the loss. So if we lost $5,000 on it, this is working against, let's say, 25,000 or 30,000 profit, whatever you have. Then you book this 5,000 loss, and then instead of 30,000 profit, now you have 25,000 profit. And in most jurisdictions, you pay about 20% on capital gain tax. I mean, it goes 19, 28, goes less and more. But that kind of saves you 20% of tax. And provided you probably had a positive year, this is an important consideration as well. So this is usually done in December. Many people do it. Again, if you, let's say, have the same amount of red as you have profit, instead of paying, let's say 25,000, so you pay 5,000 in tax. If you just close and reopen the positions, you pay 0. So you kind of save $5,000 if that's what we're discussing. So again, think about the reasoning behind taking an action is it can be quite complex. I think risk management is clear. I think tax harvesting is clear. The third one is rebalancing. So I look at the portfolio and the weights of the portfolio, especially in terms of the value amount, and I want to make sure that there is a good balance of UK stocks, small cap stocks, biotech stocks, and so on. So in this case, I actually wanted to rebalance. So actually, as I said, I wanted to increase a little bit exposure to biotech. I actually have someone with the biotech background coming on board, so I'll talk about that a little bit later. And I fully believe in Atenex, would gladly have much more, probably buy quite a bit on my private account. And I think it can go, this is one of the companies that if just things started moving for them, it could easily 10x as well. It's a risky one. The trend obviously has been really, really down. We lost a lot of money on it, so it's not great. But if I look at 3-5 years, I'm pretty sure that the Atenex will come back to much higher levels, especially that it has a lot of drugs already commercialized on top of the things that they're trying to develop. So that's rebalancing. So I always look at least every month how to rebalance the portfolio, where to reduce the exposures, when to increase the exposure, and make sure that everything is aligned. So let's say like Peloton was the biggest company. I started taking profit to rebalance the exposure I have to Pelotons. Let's say I had 7%, but it grew to 11%. Now it reduced it to 7% again. So invested amount would be maybe 5%, and then the value would be 7.5. But I don't want to have 11% value, so I take profit and redistribute it somewhere else. So that's all about rebalancing. All fund, like most funds, would rebalance monthly, and to make sure that they have the exposure that they want. So that's also important. Now, and the fourth one is also the sync. So if you come back to the discussion about the risk, right? So copiers copy the invested amount. So in terms of exposure, they would get this 10,000 exposure to Atonex, whereas I only had 500 because I went 50% down, right? So a new copier who would copy would actually get double the exposure of Atonex that I have, which is not fully in sync with the portfolio. So for me, closing and reopening to, let's say, 7,500, then it brings us exactly to the same exposure. So when a new copier comes on board, they have exactly the same amount of Atonex as I have, and therefore this makes sense in terms of synchronization issues on eToro. So everything that's 50% up or 50% down, this will already create different entry point, different exposures to your portfolio. So to recap, this risk management, there's tax harvesting, there's rebalancing, and then there's synchronization issues. So again, I've mentioned it many times. Maybe this video will serve as a kind of go-to to explain that. And again, I'm making sure I make as much money as I possibly can. And therefore, the extension of it is also trying to do the same for you. So there's nothing about like me trying to, I don't know, on purpose make bad numbers, which I've done the second half of the year. In terms of my numbers are bad, but obviously that was not purposeful. I do believe in every stock we have in the portfolio, most of the stocks, and especially the top ones. So I've reviewed them multiple times, and now there's an elephant in the room here is the spread. So obviously, if you sell and buy, if you sell it at a kind of a different price of buy and sell, there may be a spread issue. So if I sell Atonex at 178 and buy it at 179, then we pay this spread, which would be not even a 0.1%. So that's practically irrelevant. And also the discussion here is not, from my experience, if I sell it, especially that I manage over 2 million or 2.5 million on eToro, this will drive the price down because there's a lot of sellers and a lot of copiers selling, and rebuying is probably about the same. So I don't do any scalping. I'm not interested in any of that. But if I just close and reopen, actually the spread element is usually reduced by the fact that I drove the price down a little bit and then kind of drove the price up back as I'm rebuying. So obviously, I don't have 75 million like Jay or more than he has, or Yeppe, but even at 2.5 million for small companies, you tend to move those a little bit. So the spread element is practically reduced. So okay, we covered Atonex. Now let me talk about small caps, because a lot of people ask me about DNPX, census, and I put a post last week about Boxlight, TBLT, and Veeps, and then there was one more, Aston Martin, and one more. I believe in small caps recovering as a sector. This is what the data is telling me. Small caps are historically outperforming. They usually outperform the bigger indices. This year it's been completely different. The indices are up. S&P is like 25% up or so, whereas the small caps are really kind of zero down, and so on, and our small caps are really down. So I believe the whole sector will pick up. We are trading, I think, around below 15 PE at the moment, whereas S&P is like 25. This is a big discrepancy, which again, I believe in the data and the analysis that I make, that I don't make emotional buys and sells. I fully believe that small cap market will pick up, and when it will pick up and those companies that we have will go 50%, 100%, 200% up, I will sell some of those that I don't believe in the most, or rebalance again. So if Boxlight triples, then I will reduce the exposure depending on the risk-reward factor. So in terms of small caps, I am convinced that they will pick up as a sector, and there will be a big rapid rally there. I had 2 months that I generated over 20%. So I'm not saying there's going to be another 20%, but I do believe there's going to be another double digit very soon. And this will be largely driven by small caps. Now, biotech, which we can include as a subsector of the small cap. So, well, I have a lot of Boxlight, a lot of, I think, yeah, the fifth was IRO. Boxlight, IRO, and TBLT are three kind of the biggest. None of them is biotech, but I like them because they, I understand the businesses well, and they are generating good revenue. They could generate better profit, but the companies are generating more and more revenue every year. Quite simple businesses to understand, quite repeatable. So I like them because they're hugely undervalued, and I think it's quite easy to say, okay, this will go multiple times out because they're not even trading at half of their revenues. That's just utter madness, and so I'm willing to keep those and increase those. In terms of reversion to the mean, we'll get the reversion to the mean, and these companies will trade at a more reasonable price. Biotech is a subsector of small caps, so many of you know me that I made 15x on BNGO, Bionano, and ASXC, Asensus Surgical, which was DRXC before. Both of them made me 1,500%. I sold at the top, so thankfully, and I have some of that remaining, keeping that long term. So the important news for biotech is that I agreed on the person who joined me, I think in January, who has a biomedical engineering background and work in venture capital to research the funds and research the companies and decide which companies will make it to the venture capital fund. So it's an exactly experience that I need. So I have both venture capital, engineering, and biotech. So this person will work on all the biotech companies. This will be the first order of business. They will work on all biotech companies we have. So Atonex, Asensus, COCP, HTBX, and many others. And she will then decide, we'll build a scoring mechanism, and we'll see which ones we still want to keep and maybe increase the exposure, and which ones we want to get rid of or reduce the exposure. So that's an important one. I always like to have a person on board who's doing biotech, because I've done, since I started first year, I made 158% on the biotech stock as well. And since then, I've been investing in biotech. So it's been 17, 18 years now. But I always like to have someone who's coming from that industry, who can then vouch in terms of the product roadmap, product development, competitive positioning, and see, okay, well, is this company scalable, and do we have a 10x potential? And so this person is coming on board soon. In terms of China, also, so I was at Web Summit in Lisbon on the 1st of November. Now I'm in the south of Portugal, in Algarve. Very good kind of networking opportunities here via golf and hotels, and I have a few clients here as well. I am discussing quite a bit with Chinese investors. I generally do not have Chinese investors, but I am very interested in the market as a whole, and the Chinese kind of wealth growing, and how much of this wealth will go then into the stock market. So the companies like Vips and Yadea has been recovering, which is great. Vips is still very, very low. I believe they will come back to their previous heights, and we will have new all-time highs. And I actually expect quite a lot of money going into China from the Chinese middle class, but also international investors. I know there's regulatory pressures. I know that the government is kind of not helping out. And then there's a question about transparency and visibility of the reporting and so on. But I think the levels we are seeing at Baba and Baidu and Vips and many, many others are very, very low. There's a reason. There's obviously the risk increased, but I think it's very, very cheap, and it's very, very undervalued. So probably a little bit more risky than small caps, but also potential with the bigger upside potential, because a company like Vips is kind of Etsy or Amazon. Between Etsy and Amazon, it's a very, very scalable, pretty mature business, turning about 18 billion revenue, but valued at 6 billion, right? So I believe it's trading below 10. I'm convinced it will go up above